How's it going, traders? In today's video, we'll be looking at the best things to look for when trading counter trend using the supply and demand trading methodology. So let's get right into today's video. Alright, so when you are trading counter trend, it is important to understand that counter trend trading actually refers to the trend on the higher time frame. So on this chart here, on the gold H1 chart, this supply zone trade we took, you can see that this supply zone removed an upward trend line, but overall the trend was actually pretty much down or sideways at the time of this supply zone entry trade. But on the higher time frame on the weekly chart, which you're going to see in the next slide, you can clearly see that the trend is in fact up. So overall, this was a counter trend trade because the higher time frame had the opposite trend as the entry time frame, which is the H1 in this instance. Another important thing to understand is that there must be profit margin. Again, we are referring to the higher time frame. If there is no profit margin, there is pretty much no trade. So if this H1 supply zone trade was taking place right at a weekly or a daily demand zone, there would not be a trade to take here because it would be way too risky, because trading counter trend is always more risky than trading with the trend. So we need to make sure that there is enough profit margin on our higher time frames. Remember, we are always referring to our higher time frame. And it is also always best to look to take profit earlier than later. As you can see in this trade, we push right back to the original supply zone entry again. And why do you think that is? Well, because remember, the trend is up on the higher time frame. We are basically expecting price to continue to go up according to that higher time frame. It doesn't mean we can't take trades like this trade here on gold, but just to show you here that it was best to look to take profit even earlier than the 5-to-1. Usually for our trades, we like to look for 3-to-1, 5-to-1 take profits, but counter trend trading works usually best looking between 1-to-1s, 2-to-1s, or 3-to-1s. 5-to-1s are kind of not rare, but they're a little bit more aggressive. And in this trade, actually, the best thing to do is to actually move your stop loss to break even as soon as you can. Maybe after we go 0.5 to 1, it might be best to actually move your stop loss to break even or half risk as price moves away from your supply or demand zone. So remember, always look to take profit earlier than later. Do not get greedy when trading counter trend. It has burned me many times, and I just want you guys to learn from my mistakes. So here we have a screenshot of the higher time frame chart. In this instance, it is the weekly chart. It can also be the daily chart, which we are going to touch on in a bit. But in this instance, this is the weekly chart. And you can clearly see we have an upward trend here on the weekly chart. The upward trend line is clearly being respected. You can see we have not only the upward trend line being respected, but we have demand zones being respected, and we have supply zones being removed, which indicates basically an uptrend on this weekly chart. And this is in fact why the H1 supply zone short trade that we took was a counter trend setup. And another thing we need is profit margin. And remember, profit margin is always referring to the profit margin on the higher time frame. And what we mean by profit margin is making sure that there's a good amount of distance to the nearest opposing supply or demand zone. So in our little setup, we had that H1 supply zone short, and the profit margin is calculated by looking at where price is at the moment of that supply zone, all the way down to the higher time frame weekly demand zone. Now, this was basically an extreme example where there was a ton of profit margin. I'm sure if price all the way went all the way down to that weekly demand zone, it probably would have been like a 10-to-1, maybe 15-to-1 trade. But remember, like we touched on earlier as well, we do not want to be taking a supply zone trade right at a weekly demand zone. So let's say you are looking for a 1-to-1 or a 2-to-1 trade, but there's only like 2-to-1 distance to the nearest opposing higher time frame zone. In my opinion, that would either be no trade because we are too close to our opposing higher time frame supply or demand zone, or you would just risk way less than 1%. And I always actually recommend, if you are going to trade counter trend, it might actually be best to just risk a lower percent than your typical percent. So let's say you risk always 1% on each trade. Maybe risk 0.5% on all your counter trend setups. And then if you're really close to your higher time frame zone, maybe risk like 0.25%. And remember, like I said, we always want to be looking to take profit a little bit earlier, or at least be aggressive with bumping your stop loss to break even. Or what I like to do is bump my stop loss into the green, into the profit as price is moving away from my zone. All right, now we're going to look at the daily chart here of gold, and the daily chart would be another higher time frame to our H1 time frame. So just like we had on the weekly chart, we had an upward trend line here. However, it was not respected. It was removed as indicated as price broke below the upward trend line, as you can see on the chart right now. So the daily upward trend line was removed, and what this did is it created a sideways market. And this indicated evidence to suggest that we could be pulling back to the weekly demand zone that we were talking about earlier. And if you just think about it for a second, how is it possible for price to pull back to a weekly demand zone? Can we have a daily uptrend in that situation? No. The daily trend must change, or the daily must create a downtrend or at least downward momentum in order to reach a weekly demand zone. So why I'm showing you this daily chart is because it's all about trying to read the story of price. Remember, price is always a story. You know, the price chart indicates buyers and sellers. It can indicate trends. It can indicate where leftover buy orders and sell orders are at, which is what supply and demand zone trading is really all about. And the story of price here was telling me, look, we had a daily uptrend. Things were looking good. It looked like the daily uptrend was going to continue. It looked like the weekly trend was going to continue. But then all of a sudden, as the daily upward trend line was tested, it was removed because, like I said, it broke below that trend line. So according to the story of price, that is basically the first amount of evidence we need to suggest that price could be pulling back to an even higher time frame demand zone, which in this case was the weekly chart. So to kind of summarize again, in order to get that pullback to that weekly zone, this is what we need to see on the daily chart. So if you want to trade counter trend, this is what you would need to see to really make me feel comfortable. So let's say the daily trend was still up, and in this instance, we didn't break below the trend line, and there was that H1 supply zone still. At that point, sure, you could still trade counter trend, but you're basically anticipating that the daily trend line is going to be removed, so it would be more risky. So maybe in that instance, I would actually risk 0.5% instead of a full percent. But in this situation, we had clear profit margin to the weekly demand zone. We had a daily upward trend line removed, which indicated a sideways market, which was evidence to suggest we could be pulling back to the weekly demand, and then we had that H1 supply zone that broke the upward trend line in the H1 chart, which basically was almost as good as a counter trend setup is going to get. And this daily chart here is a really, really good indication of why it was a good counter trend setup. And remember, like I said, if the daily trend was still being respected, it would definitely be a little bit more of a risky counter trend setup. But remember, counter trend trading is already riskier because not only is it counter trend, the profit margin is always going to be cut as well. There's always more profit to be made in an upward trend, which makes it more riskier. So you want to be stacking the odds in your favor, and this daily chart going sideways was definitely an indication of it being a higher odds potential counter trend setup. All right, so here we are on a live chart here of this H1 supply zone trade here, and you can clearly see just a beautiful counter trend setup. The low was clearly hit here, and I just want to walk you through the thought process here. So this is a one chart layout here, and if you look, this trade might look good, just on its own, just looking at the 1 hour chart. Okay, we had an upward trend line, it was removed, and we shorted a pullback to a supply zone. But it's important to have, if you don't have a 4 chart layout, which I recommend, like this is my main chart link that I'm always looking at here. It is always important to look at the higher time frames. So just want to walk you through, okay, so I see a 1 hour supply zone, but I zoom out. Okay, the daily chart here, like we were talking about, it broke below the trend line. That's indicating we could see a drop in price. And then we go 1 time frame higher up here, which is the weekly chart, and that is where we look at our profit margin. So I just wanted to, walk you through the thought process here. And then once we get to the weekly chart, it's like, okay, tons of profit margin to the nearest weekly demand zone. And even on the daily chart going back, you can clearly see even to the daily chart, there's tons of profit margin. It's very easily displayed all the way down to that demand zone there on the daily chart. So just wanted to kind of walk you through the live market here to show you like the exact thought process I would have. And like I said, if price was all the way down this weekly zone, all the way down here, and then maybe then at that point we had a little supply zone short trade, well, look at the profit margin here compared to the profit margin from all the way up to here. When price is down here, that's when it becomes a lot more riskier, because at any point, this beautiful rally base, rally weekly demand zone, we could then get a reaction off of it, which just cuts your profit margin and increases the odds of losing that trade. So we always want to make sure we have the profit margin there on the higher time frame weekly charts. So it's always important to have the 4-chart layout. If not, it's always best to at least just change your chart. So do not be hyper focused on this H1 time frame or your entry time frame. We need to always zoom out and get the higher time frame picture. And it also goes the same for trading with the trend. Maybe the same thing happens where we had the upper trend line on the 1-hour chart, we broke below, leaving us with the supply zone, and we were looking at trading this supply zone short. And then maybe you zoom out, and maybe the weekly time frame is trending down and the daily time frame is trending down. Well, at that point, going back to our H1 time frame, maybe you wouldn't have taken profit here at the low, and maybe you would have left a little bit more wiggle room, not been so aggressive to put your stop loss to break even, and you would have let the trade run out a little bit longer. Now in this instance, like I said, price did in fact push all the way back up to the entry, and why I think that took place is because the weekly trend is up. So this is a counter trend setup. This is why I think we've seen this big retracement after the big move down. But like I said, if the higher time frames were trending down, then we probably wouldn't see this big move back up, which could have basically left you, taking your stop loss, moving it, somewhere around here, maybe moving it above this supply zone there, and then maybe price continued to drop. You just keep bumping your stop loss out, and eventually, you would be stopped out for a profit, but it could have just given you more wiggle room, which is why it's always important to look at the higher time frames, not only to see, if there's an opposing demand zone in control here, or if it's counter trend or not, but just to see how much profit you can really look for, because you always want to be maximizing your profit, as best as possible. And this trade was called out in the daily market breakdown video for the Diamond members. This was posted in one of the daily forecast videos. It was a counter trend setup, but it was a beauty. So just wanted to point that out. If you guys do want access to these daily market forecast videos, check out the Diamond membership. We have much more to offer as well, with video lessons, Sunday Zoom sessions, private Discord group, and much more. So check it out. We'll be happy to see all serious traders join the team. That is going to do it for today's video, guys. Make sure to subscribe and like the video if it helped you, and do not hesitate to leave a comment and ask a question if you have any questions. I respond to every single comment that I see. And if you want more tips on how to trade supply and demand, or want my forecast videos, make sure to check out my trading tips playlist, and like I said, the membership as well if you want more in-depth learning and forecasts. Anyways, I will see you guys in the next video.